Joining me is Dom Guiliano, Chief Investment Officer of Magellan Financial Group. Welcome, Dom.
Good afternoon, Mark. Deputy Chief Investment Officer.
Deputy Chief Investment Officer. Where most people have forgotten about quant easing, or money printing as it was commonly called by normal people after the GFC. We're about to see a change in policy from where I sit into 2018. So I'm particularly interested to talk about quant easing and the unwinding of quant easing, and how you see things happening from there. And just as importantly, why it's important for investors to be across this. So can you start just by giving us a quick history lesson on quant easing and what's happened so far before we get into what the future might hold?
Yeah, so we need to rewind the clock probably about 5-6 years now to the point when the central banks had exhausted their conventional monetary policy. And conventional monetary policy is just reducing interest rates at the short end of the curve, and the aim there is that with lower interest rates people will spend more and also businesses will invest more, and that should be stimulatory. But central banks had actually reduced interest rates all the way down to zero, and they still were wanting to ease monetary policy and actually continue to spur investment and spending. And so the way that they did that was through what is known as unconventional monetary policy, through a mechanism called quantitative easing. And what quantitative easing was all about was actually trying to reduce longer term interest rates to lower levels so that people would borrow to spend, and also businesses would think about borrowing longer term and also spend more. And the way that they achieved this was actually to, in essence, print money and to use that printed money to go out and purchase sovereign bonds, their own government sovereign bonds, and also in the United States MBS, so mortgage-backed securities. And in the Eurozone, a similar policy was implemented a couple of years after the Fed, and they also did a similar thing. And it seems as though they actually broadly achieved their goals. You actually saw...
We've seen long-term interest rates lower, haven't
Absolutely. Interest rates right along the duration curve have all come down to record low levels, and that has been supportive to investment and to spending. How supportive, it's hard to know because it's a counterfactual, but it has certainly been stimulatory and helpful.
And so we seem to be at an inflection point where that's been done, and now the discussion is turning, well, it's more than a discussion, it's now turning to how do we rein this back in. And just before we cover that, can you give us a feel for the quantum of how big this quant easing program actually is?
Yeah, it is very, very large. So between the Fed in the United States, the European Central Bank that looks after the Eurozone, and the Bank of Japan, you're looking at something like $12 trillion plus of printed money that has then gone back into world markets and has purchased investment securities in the sovereign space, fixed income space, as well as certain types of mortgage-backed securities. Now, it's important to note at this point, Mark, that all of that buying has then displaced private investors from those markets who are then scrambling around looking for yields. And that has actually chased up asset prices in a range of places. It's not just the fixed income markets which have been impacted. So in our world as global equity investors, where this has touched us is that all of this printed money has displaced investors, and those investors searching for yield have also gone hunting for yield in the very high quality defensive equity space. And that's actually caused some significant price increases in securities that we would like to buy but are simply too expensive now. So some of these securities, the expensive defensives as many are calling them, you've seen PE, price to earning ratios increase historically from the 16 to 17 times level. Now that a lot of these securities are trading at 21, 22, 23 times, because of this hunt for yield and the extraordinarily low interest rates that we are seeing. So you've seen a massive price appreciation in a number of these securities.
So we've had $12 trillion enter the financial system, which has kept long-term rates low, but driven up prices of shares, properties, and also fixed interest investments for that matter. So let's wind the clock forward to 2018 and beyond. How do we get out of this, or how does it unwind from here?
Yeah. So the central banks have been very careful to flag the mechanisms that they're going to use to unwind the size of their balance sheets. And by that I mean to unwind the size of those $12 trillion worth of assets, which they have sitting on their balance sheets, which have been purchased with printed money. And so the telegraphing approach really began early this year with Yellen at the Fed telling people how they were going to do this. And then in June of this year, they telegraphed to the market that the first step in reducing the size of their balance sheet would actually be to stop reinvesting maturities back into the market. So if you could just imagine a simple example, let's say the Fed owns $1 billion worth of US government debt that has been purchased with the printed money, and it's due to mature this month. What they would have done previously was to take the principal from those who had invested that money and would have gone back and just repurchased another $1 billion worth of US government debt, so that the overall level of debt would have stayed the same. What they're going to start doing, and what they've already started doing, is they're going to stop those repurchases to the tune of about $10 billion a month for 3 months, and that will just gradually increase, but $10 billion every quarter until they get to $50 billion a month. They will stop those repurchases. So what that should do over time is that the size of their balance sheet will decrease, and what that means is that the amount of money in the economies chasing those assets should reduce. What does that mean? That should mean that the level of interest rates at longer duration should slowly increase to more normal levels. I have to say here, Mark, this is the first time it's been done. It's an experiment. Yes. The Fed has said it, everyone's acknowledging it, but what they're doing is they're trying carefully to avoid surprises. Yes. So they're informing the market very carefully as to what they're doing, the time frame, and also telling the market that they may well revise their plans if economic signals are different. If inflation is higher than they expected or lower than they expected, they can go back and revisit these plans. So that was announced in June of this year. The European Central Bank is still on the journey of printing money, but they are beginning to taper, to slow it down. So at the end of last month, Mario Draghi announced that the rate of money printing would reduce from 60 billion euro a month to 30 billion euro a month, all the way through to the end of next year, if I'm not mistaken, and then they will retain the flexibility to review that depending on what the economic circumstances are in the Eurozone. It's important to remember that all the while in the Eurozone, interest rates are at 0%, and if banks want to park their funds with the European Central Bank overnight, the banks have to pay the European Central Bank 0.4% for that privilege. And so the European Central Bank is still trying to encourage as best they can the banks to lend money to households, to lend money to businesses, to invest and to continue to spur economic growth, because you still have inflation. Inflation is still well under 2% in both the United States and in the Eurozone. And so the nature of the recovery is still somewhat delicate, and more delicate than people expect, given the degree of monetary policy accommodation that exists both in the federal, in the United States, as well as the Eurozone.
So they're really looking at letting this thing down gently, if you look at it in that respect, that they've pumped up the financial system with a lot of air, if you call it that, and they're looking to gradually just take the air out of the tyres, and they flag that. You can use that later. Well,
hopefully they won't get a flat tyre and the car stops in a rut,
And I think the thing that why is it such an important issue for investors such as us to be thinking about? I think that's what I'd like to finish on.
Well, $11 trillion plus has entered markets, and slowly, that $11 trillion is going to come out. And as I said earlier, this is an experiment. So it'll be interesting to see how the markets digest that reduction in funds out there, and which asset classes will be hit. And there's been a lot of spillover into many asset classes, and there's been very strong markets of late. So it really is hard to say this asset class has risen solely because of this monetary policy accommodation, and this asset class has risen because of good fundamentals. It's very difficult to see that. And then all the while, central banks aren't perfect. They could make some policy mistakes here. Perhaps the pace is too fast, perhaps it's too slow. What happens if there is a snapback in inflation? That might have some very interesting impacts for yield curves, which could then spill over into global equities as well. So, we should see a reappraisal of assets, and indeed we may see increasing levels of volatility in markets, which is something that we really haven't seen in quite some time.
Yeah. And so if you were to see a likely journey forward from here, how do you see things playing out in 2018 with this?
Yeah, well, the central banks have been very good at communicating their intentions, so there should be no surprises from the monetary policy front, barring an accident.
Yes. Yeah.
Barring an accident, barring a geopolitical event. Yeah. So putting those two things to one side, we do anticipate a gentle and gradual increasing in interest rates and a steepening of the yield curve, which will have a modest impact in some areas of markets. And we've positioned the portfolio accordingly. Yeah.
And finally, there's been a new appointment to replace Janet Yellen as well. Are you guys happy with the appointment to the US Fed, or do you see that having any impact at all in this?
It doesn't appear to be a controversial appointment in terms of approach. There might be, where you might see some interesting things happen is not really in the monetary policy side, perhaps more in the financial regulation side. It is it's a policy initiative by the current administration. They've been very clear about it, that they actually want to reduce the degree of regulation across all businesses, including the financial sector. And so maybe the new incumbent, or rather the new appointee, will actually reduce some of the regulation that currently exists in the banking system. Whether that's for the better or not, we'll find out in a decade.
We'll see. That's great. It is an inflection point here with interest rates and the great experiment of quant easing, and a lot to look for investors going forward. But clearly $12 trillion coming out of the system will have some impact with interest rates and asset prices. So we're just going to have to stay tuned and see what happens. Dom, thanks for your time.
Pleasure. Good speaking with you, Mark.